Okay, hey guys, happy November. It's November 1st, 2014, and I've wanted to do this video for a while. I got several questions from people asking if I can explain exactly what it is I'm looking for when I enter the market. And so I thought I'd do a video to talk about my actual setups and how I categorize them, how I organize them for journaling purposes and for review purposes. Now, as I was putting this together, I realized that there is just so much stuff to cover that I just can't in a single video. So what I'm going to do is split this up into multiple parts and just cover as much stuff as I can. But let's get started. So the first thing I should talk about is the kind of trader that I am. I am an order flow trader. And if you think of trading in terms of its two schools of thoughts, there's fundamental trading, there's technical trading. Fundamental traders are looking at fundamental data. So, for example, if an investor wants to buy stock in a company, they don't look at the charts, they don't care where they're entering necessarily. They just look at a company and they look at the things like profit and loss and balance sheet, and they make their market decisions that way. Whereas a technical trader is looking at the chart and they're looking at price patterns and they're looking at profit from recurring price patterns. Now, as an order flow trader, what I'm doing is I'm looking at the chart, but I'm constantly thinking about what other traders are probably doing based on what we're seeing. Another way to put that is it's called playing the meta game. Which to illustrate that, if you would imagine playing a game of chess against an opponent, and there's a series of moves in chess where your opponent can checkmate you in four moves, given the right moves. Just imagine that you're playing that game over and over again, and your opponent pulls the same moves on you each time, and each time you lose. Now, if say after the fourth time doing that, let's say you play the fifth game and you adjust your strategy based not on the pieces on the board, but based on uh, the likelihood that your opponent is going to play the same moves again. The moment you're doing that, that's when you're playing the meta game because you're no longer playing the board, you're playing your opponent. So it's just a way that I think about trading when I enter the market. I see the same price patterns. I see recurring price patterns, but what I'm really thinking about is really about the other traders that are in the market because it's their order flow, um, either out of the sense of having to get out of the market in terms of urgency or excitement, or they're entering the market. It's that order flow that generally creates some of the best moves in the market, and so that's what I'm looking to take advantage of. So I'm constantly thinking about what the other traders in the market are doing based on patterns that we're all seeing. So what is it exactly that I'm looking for? Now, so in a nutshell, I'm looking for any instance where I can infer that the majority of traders, otherwise known as the herd, have just taken the wrong side, and then I look to do the opposite. This happens in two places. One is at key levels in the market, which is the where in the market. What price levels are a lot of traders likely to get involved in? And the other is after particular price action, which is a form of timing. So when are traders likely to get involved in the market? If I can't infer what other traders are doing, then I probably am those other traders. Um, so that's just important to keep in mind is that I have to know what the other traders in the market are likely to be doing for me to be able to take a trade. My setups fall into two categories. This is going to seem really basic, but this is how I categorize them in general. So it's just important to know that I take reversals, which are counter trend, and momentum setups, which is times when I trade with the trend. Now, it's important to know and just understand that, and this is going to be really obvious, but um, the reason I bring this up is because my natural inclination when things would just it didn't seem to be going well, uh, is to look for a new setup to trade. And it's just important to understand that because there can be many things that could be wrong with your trading if you're struggling. And so learning a new setup is not going to suddenly, make riches fall from heaven. Uh, and again, that seems pretty obvious, but it's just important to keep that in mind. There are other things that are all part of trading in general. There's things like your process, your trading process. Um, Anyone can learn a setup, uh, and honestly, if everyone did, and that was all there was to it, then everyone would be profitable. We know that's not true. So there's things like process management, there's risk management, there's also trade management, which is where do you enter, where are you getting out, where's your stop, where's your target, and then also psychology, which is basically what is your emotional state, how do you respond to the market, and what is your psychological response to the market. Any one of these things can be wrong with your trading. It could be one thing, it could be all of them. Um, and if that is the problem, then finding a new setup is not going to help you. So it's just important to know. What is my most traded setup? All right, so I am most comfortable taking reversal setups, as you can see here. So I do take momentum setups, but the reversal setups are really at my core. I've always been averse to trading with the trend because in my mind it's sort of it's a form of going with the crowd, going with the herd, and what I'm trying to do is take advantage of the opposite. So it's difficult for me at times to trade with the trend, but there are times when that's warranted. Now, just some stats for my journal. I thought I'd pull these up. My current strike rate with reversal setups in general, and this is scalping only, is 64%. Now, that may not seem like a particularly high strike rate, but it's still a profitable strike rate. And my expectancy is 0.46R. So what that means is that for every dollar that I risk, I can expect to make 46 cents, to put simply. Expectancy is, you probably have heard that sometime or another that in order to succeed in trading, you need to win more than you lose, which is not true at all. That's only half of the equation. Your expectancy, whether you're profitable or not, is really made up of three things actually. One is your win versus your lose rate, which actually can be reversed. You can still have a profitable strategy if you lose more than you win. If your average winner is more than your average loser. And there are strategies like that, and they're very profitable strategies like that. And the third part is how often you're trading, how often you get a trade, because it is possible to have a higher strike rate and a good average win over loss. But if you don't get as many trades, you can actually someone can make more than you by having a lesser strike rate, but actually having more trades because there's more trades to carry out that edge. And so it's just something to understand that it's not just strike rate alone that counts towards a winning strategy. Looking at momentum setups, I have about the same strike rate with momentum setups, and you see it's about the same. So about 4 out of 10 trades I take, out of every 10 trades I take, I can expect to lose about 4 on average. And my expectancy with that is currently 0.38. So still profitable, but and of course I'm always looking for ways to improve strike rate, and looking for ways to cut risk and to increase winners, and that's really what it's all about. The only way you can do that is by keeping a journal. and not just keeping a journal, but reviewing the thing, because it's in the review and finding the connections between, what connects your losing trades, what connects your winning trades, what do you find yourself doing over and over and over again that could be improved. And this is all, I mean, this is basic stuff, but uh, the things that you learn from your journal are things that no one can ever teach you. And um, if you're not doing it, there's another trader out there that is, and he'll likely beat you. So it's just important to keep that in mind. So let's get on with my setups in detail. All right. Now the first thing that I want to say is that while I categorize everything in a specific way, you'll find that a lot of these look the same, and the truth is that they are. Everything is connected, and I think that's sort of like the revelation I make when I started to become successful at trading, was that realizing how everything connected in the market. And the truth is that there is one market, and so even markets that are markets are correlated. There's a vast amount of markets, but they all work together. And the other aspect is that even in the chart patterns, everyone can say, "Oh, I'm seeing this," or "I'm seeing that." I'm seeing different things. You can ask, 5 different traders, and they can say, "Well, I'm entering here because of X, and another trader is entering there because of Y." And the truth is, they're all seeing the same chart, um, but everyone has different reasons for entry. And just to illustrate this a little bit, I'm going to just draw something out here and just explain something. Let's see if I can do this. Okay. So there is a setup that I know very well, and it's called a pin bar setup. And the basically it will look something like this. So the market, let's just say that the market has been rallying up. And let's just say that it does something like this. Oops, I didn't want to do that. Okay. And let me just get some color in there. Okay. All right. So just look at this and just pretend that this is the market and this is a price pattern. This bar here would be a pin bar. It's also known as a hammer candle. There's a dozen different terms for them, probably. But the basic idea is that the market has broken a high. You can see that the market has been trending upwards and has put in a high here and then rejected sharply and closed back within the range of this candle, and preferably with a pin bar setup. There'd be a greater level of resistance, probably, it's probably up here, something for the market to actually have rejected. But the bottom line is that this candle has closed in well below this level and well within the range of this candle here. So the way that these are traded as a pin bar setup is a lot of traders, what they'll do is they'll look at this and say, okay, this is a great pin bar setup or hammer setup or whatever. I'm going to sell the break of that pin bar. All right, so they'll literally place a sell stop order to get in the market so that when the market continues, um, they'll get their position on that way. And their stop will go above the pin bar here, the wick, the extreme of the wick. Now, so that's a particular setup. Uh, but let's say that I were to look at this on an hourly chart, and I'm just drawing this out, so obviously, it doesn't always happen. But just imagine that if I were to drop down on an hourly, I might see something like this, where the market has let's just draw out that level of resistance that we had, so we can just pretend that we had that level of resistance. And what's happened is, let's just say that the market has, let's say, okay, so the market's been trending upwards. It's done something like this. It's broken through and then closed back below that level of resistance. All right, and then the market starts to do something like this. All right, now at this point, let me just go back here and just draw something. Let's just say that, for the sake of argument, that the next candle looks something like this. Okay, so in this particular setup, you can see that those people that had entered with the sell stop had gotten in the market on this candle. All right, and before it did that, it actually retraced a little bit and then pushed through, filling those orders. All right, on an hourly time frame, you might see something like this. The market has retraced and then start to come back down. Now, anyone who's read a technical trading book will immediately know what this is. This is a head and shoulders pattern. All right, and the way a head and shoulders pattern is played usually is a lot of traders will look to short the break of the neckline here. All right, the head and shoulders pattern, just to clarify, this is, so this would be a shoulder here, this would be the head, and this would be the other shoulder. So this would be the neckline, and so a lot of traders, once they recognize that this head and shoulders pattern, they're putting their sell stop order here, expecting a break and continuation to the downside. All right, now this is the hourly time frame, and this is the daily time frame. And you can see that these are two different setups, but they really are the same thing. So you have one trader that's looking to, they look at, they see a pin bar pattern, and or a hammer candle, and they're looking to short that way based on that. Other people are looking at a different time frame. They see a head and shoulders pattern, and their entry is exactly the same as these traders here. So yet another trader might look at this and say, "Oh, well, wait a minute. This is, let's see here. We got a higher high, higher low, another higher high, another higher low. Wait a second. This is an Elliott wave. We have 1, 2, 3, 4. Excuse me, I got that wrong. Let's see. We got 1, 2, 3, 4, 5. And then the markets come back down. This could be, oh, wait a minute, this could be A, B, and they're going to look to short here based on that this is a trend reversal pattern. So yet someone else might look at this and say, okay, well, this is a different pattern. Again, it's all the same market. It's all the same chart. So it's just important to recognize that when you look at the setups that I'm trading, all this is interpretational. And so you might look at that setup and say, well, wait, that's not an X so-and-so setup. In my mind, it's just, this is the way that I categorize things, and it's when you make it your own that things start to come together. So let me pull that out of the way and get back to the presentation here. So a lot of setups are the same thing, just different time frames, different variations, different interpretations. But bottom line is that I'm looking for the way that traders are trading these and what they're likely to be seeing, and where they're likely to be getting involved. So where's the order flow? Okay, so I am going to cover just the reversal setups in this video. I'm probably going to save momentum setups for another video, just because of the amount of stuff that I would like to cover. The other thing I'm just going to say is that there are some setups that I'm not going to cover out of courtesy to those that I learned them from. I think you know who I'm talking about, but if you are interested, just drop me a line, and I'm happy to send you an email with a referral or something. So where do I look for reversals? All right. The first is at key levels. This seems very obvious, but it's at the core of my trading. I am a levels trader. I'm looking for levels to do business at, and so it's one of the first things I look at for a potential reversal. Uh, the other place or time that I look for a reversal is after what I call false momentum. And this is just my own term for it, and I don't really know what to call this, but I'm going to give some examples of it to show what it is I'm talking about, and hopefully become clear what I mean by it. The other is after a momentum move. Now, what's the difference between that and false momentum? Aren't they the same thing? Well, after a momentum move, there usually is some form of retracement. And what I'm looking to do there is get in at the top of, or if it was a bullish momentum move, I'd be looking to identify the end of that momentum move and take a reversal at that point. The other one is a little bit special, but it's basically the ABC pattern, or you could call it a 1-2-3 pattern. It's something I just called the C point. And the thing about this is that this ties in very closely with a key level, because it is in relationship to a key level. But I'll explain the way that I see the nuances for it and how it's just a little bit different from a key level. So let's get into reversals at a key level. What are key levels? All right. Now, this is hard for me to put into specific boxes because they really are all related, and I would prefer to have confluence between them. So the first one I have on here is round numbers, but it's important to know that I just don't take a blind trade based on a round number alone. So while I do consider it a key level, it's not that I just don't look at a big round number and just say, well, okay, I'm just going to blindly enter a trade here. But it is a key level, and just to clarify what a round number is a psychological number. When you go to a gas pump, you generally don't ask for a price that is off of a round number. For instance, give me $46.72 worth of gas. You would just say, give me $50 worth of gas. Round numbers are easier to remember just because we're human. And so the tendency in the market is for orders to stack in those areas because the larger traders or bigger investors generally want to enter the market. When they tell their broker to enter them at the market, they basically give a round number versus a very particular price because it's just sort of odd to do that. So as a result, it's something to look for. It's because there will be orders there. The other things I look for, which I consider key levels, are instances where ranges have formed. So the top of the range, the bottom of the range will be a key level for me to look at. Why? Because at ranges, the way that people trade them, generally when a range is formed, a lot of traders are looking to figure out, they're looking to enter the market based on where the market's going to go, which they don't know yet because the market is channeling sideways. And so, for example, in a range, a trader would look to buy the top of the range, buy a breakout of the range, that is, or short a breakthrough to the downside of a range, and use that as confirmation that the market has now found its direction. And I'll give some examples of that. The other is a break and retest. So I'll consider a key level anything where the market has formed a level of support and resistance, and then broken out of that support and resistance, and then comes back for a retest, the underside. And I'll give some examples of that, but just to do a quick illustration of that, this is support and resistance 101. So, but just to clarify, just in case. basically you'd have an instance where the market is doing something like this, and then it becomes clear that there's a level of resistance. You could also say there's a level of support down here, but let's just say for the sake of argument that the market finally does break out. All right, well, this level becomes a key level for me because I'd be looking to bid the retest of that level once it touches. And this is basic support and resistance that resistance becomes support once it's broken through, and vice versa. But just to clarify the reason why, the psychology behind that, is because what's happened from an order flow perspective is that you've had sellers that have been selling this level of resistance previously. So what happens is for any sellers that have been holding on to their positions once price is broken through, those sellers are now offside in their position. So if the market were to come back, this would be their break-even point. These sellers, this would be their break-even point. So those sellers realize that they can get out at scratch, and they can just cut their trade. And they were offside previously, but now they can get out scratch. So most sellers would at that level that they had originally sold. And so that's just the basics of why resistance becomes support and vice versa. So basic stuff, but just want to make sure I clarify that to be thorough. The other setup is the other key level that I consider is called the left eye. And this is just in particular to a pin bar setup. Let me pull up my drawing again. And if I take a look at this setup, this is again this pin bar setup here, and we have the pin bar there. The reason why it's called a pin bar is because it stands for Pinocchio bar, and the basic premise is that what this is Pinocchio's nose, and Pinocchio is telling you that the market's going to go up, but the longer the nose, the greater the lie. So it's Pinocchio telling the markets, saying that the market's going to go up, but Pinocchio is lying to you. It's saying that the market's actually going to go down, and so that's how it gets its name. So what if this is the nose? This would be the left eye, and this would be the right eye of it's supposed to be Pinocchio's face somehow. But that level, this level here, would is for it's formed by the break of the high of this candle here. So what I would do, just when I say that I'm looking for a left eye setup, is basically that when the market has formed this kind of a formation, has broken out of that level and then closed well back below it, then I'm looking to, in this case, offer the retest of the left eye, which would be that level. So, and it works the same way. If I'm looking at this pattern here, I would still look at this and say, okay, well, that's the left eye, that there, which you could say is the high of the left shoulder. Same thing. It's all the same thing, but that's what I mean when I say left eye. And the other instances, although I don't like trend lines for a number of reasons, which I'm not sure if I'm going to get into now, but I do look at trend lines and I do consider them because generally I use them as a form of confluence. So let's just say, for example, let me draw out let's see here. Let's just say that we had an instance where the market was doing something like this, and has shown that there's a level of resistance here that the market has broken out of. I'd already be looking to bid the retest if price were to come back here. But as an added factor of confluence, I'd also be noticing that there is a trend line here. And if you can see, if the trend line happens to line up perfectly with that level of resistance that turns support, then this would be a no-brainer. So there are instances where I do look at trend lines as a factor of confluence. They are a key level for me. I wouldn't actually, just to correct myself, I wouldn't call it a key level because it's technically a level is a price level. So a trend line is variable because the price changes based on at what point the market comes back to the trend line. But suffice it to say, it is a place where I look for a reversal. So I guess that's really what I'm trying to say. All right, so let's move on to the way that price needs to trade into a level for me. All right, price has to trade into a level in the right way. All right, and the most basic aspect of that is, again, from the perspective of order flow, I'm looking to enter at the point where a lot of traders are likely to get involved in the market. And one of the times when a lot of traders will get involved is after particularly bullish price action or bearish price action. And what that will look like is if I were to draw out a candlestick, this should be really basic, but it'll be a candle that looks something like this. So, just consider maybe the other candles had something like this. And let me just colorize these just so I can just say we have a big red candle here. Oops, I don't know what it did there. Okay. Now, if I were just to look at this by itself, if I were to ask myself, on which of these candles would you think most traders would be likely to be selling? I think the answer is pretty obvious. It would probably be this one. All right. And, so obviously, looking at just this example, that, there was probably selling going on here, selling going on here, selling going on here. But a lot of selling would have come in on this candle. And so I'm looking for something like this to tell me that, okay, I have a good bet that a lot of traders have been piling on. Now, if this were to happen at a key level, say that I have a level here that I know that I want to buy, and price trades into it like this, that actually strengthens my case for a buy. Because not only is it trading into the key level that I wanted to buy originally for whatever reason, but the way that price trades into it means that a lot of sellers have sold into it, which creates the order flow I need. Because what that now means, for a number of reasons, but one thing is that I have a good guess that the herd, a lot of traders, have just taken the wrong side, selling into a level that's a good area to buy. All right, and what a lot of traders do, they usually a lot of traders tend to pile on at the worst place possible. A lot of traders want to sell after they see a big bearish candle like this, whereas the pros are looking to buy into that, because what these traders are doing are just providing liquidity for those pros that want to buy at this price, at this wholesale price. Sellers have a tendency to sell at wholesale and buy at retail prices. All right, and the pros do the exact opposite. They want to buy at wholesale prices, and they want to sell at retail prices. But it's something I'll try to get into. But the reason I bring this up and talk about when I say that price needs to trade in the right way, what I don't want to see is, let's say that I have a level of support here, and it looks great, and I want to buy this level of support. But what's happening is that as price is trading down into it, it's doing something like this. I'm going to try to illustrate this, but okay. And let's just say that, okay, let's just draw out a couple colors here. Okay. Now, as much as this might be a level I'd like to buy, I don't want to see price sort of drifting into my level. All right. Another way this is known as some people call this a stair-stepping pattern. Same thing. It's other people have termed this. It's called the drift of death. And what's happening is that before prices come into the level, you'd see something you see even like wicks coming into this level. What's happening is that people are buying ahead of this level. All right. And more buying is coming in ahead of this level, more buying is coming in, more buying is coming in. What I don't want to have is a crap load of buyers that are coming in before my level, because what's happening is I know that first of all, stops are accumulating from those buyers. All right, so that's one thing. And the more this happens, the more stops are starting to accumulate in this area. All right, now these are liquidity pools. These areas of stops are liquidity pools for the pros that want price to trade down into that so that they can get their position on. And something else I go into, but just a very basic thing is that the pros um, have a very hard time getting a large position on because of slippage. They need the liquidity of a vast amount of sellers, which is going to happen if all these sell stops are triggered, in order to get the size that they need to buy into the market and get their position on. But I can go through all the mechanics of that, but suffice it to say that this is not what I want to see. If I have a level that I want to do business at, I want to buy at this level. I don't want to see prices sort of drifting into it. That's usually a bad sign. Because it's giving opportunities for all these people to buy. I don't want that. What I want is for everyone to be selling. So, anyways, let's move on. So basically, price must trade into a level or break through it in such a way that I can infer that a lot of traders have just stepped in, they're likely to be getting involved in the market, and that usually shows up in the form of momentum. But you can see it. It's momentum. You can see it in the price action. But basically, what I'm doing is I'm looking at the candles, looking at the candle formations, and just seeing how those you can see when traders are just piling onto a move. And so, anyways, let's go on here. So the first setup that I'm going to talk about is a reversal at a range. All right. Now, this setup is a bit of a misnomer. This is just what I call it. There are many different names for this. You can call this just a range play. Another term is just a breakout failure. But basically what I'm looking to do is I'm looking for a failure of a range and looking to trade it back to the other side of the range. So there's two criteria I'm looking for. is that first of all, there needs to be a range, and then it needs to look like the market has broken out of the range in such a way that I can infer that traders have piled onto the move. All right, because what are traders looking to do? They're looking for the market to find direction. They're looking to trade with that direction, and so it needs to look like the market has found its direction. And then what it needs to do is sharply reject and trade back into the range. All right, now sometimes I will take a trade before it's actually traded back in the range, but it's just based on context. But that's the general idea. Before I show an example, it's important to understand the order flow behind ranges in general and how the masses usually trade these. So let me draw an example of a range. And let's just say, for the sake of argument, that the market was in an uptrend, okay, and then has started to pull away. All right, now at this point, we don't know that we're in a range. Let's say that the market then starts to do this, okay. Okay, so now it's clear that we're in a range. And there's several things that are going to happen. First of all, anyone who's on the sidelines now sees the range and they're thinking, okay, I want to get in this market somehow. I don't know which direction the market's going to go. So what they do is they will put a sell stop order below the bottom of the range, buy stop order above the range. And whichever order gets triggered, the other side of the range becomes the protective stop. So in other words, if this market were to continue break out of the range, then these buy stop orders will be triggered. They're in the market, and then their sell stops are going to be on the other side of the range because that's where they're wrong. And then the same thing for if it's vice versa. So if the market were to break to the downside, these sell stops will be triggered. They're in the market, and then the protective stop goes up above the other side of the range. Now, additionally, for those people that were in the market to begin with, we had buyers who were already in the market at the bottom of the move. All right. And once the market starts to go sideways, what a lot of traders will do is, if it looks like the market's stalling and those traders are well into profit, what they will do is move their stops up to tighten their stops. All right, so you're going to get additional sell stops below the range from those traders that were in the move to begin with and have now moved to tighten up their stops. Okay. Now, additionally, you're also going to have people who, before the range started, have seen, let's just say for the sake of argument that we also had a level of resistance right in the middle of the range, okay? You're also going to have buyers that have probably bought the break of this resistance level looking for continuation upwards. But what's happened is the market seems to have found a top and then starting to retrace back down. Now, at this point, we don't know that there's a range yet, but what will happen is a lot of sellers looking to sell this market, looking at this and thinking, okay, well, we had a level of resistance here. It looks like the market's found a top. I'm going to sell here. All right. Well, once the market starts going sideways, if their stops weren't above this high, this swing high to begin with, you can bet that their stops are going to be brought down to the bottom of this range, because once it's clear that the market is ranging, if the market were to break out, then they'd be wrong on the trade. So you're going to have additional protective buy stop orders above the range itself. So bottom line is that there's two areas that are forming liquidity pools, and it's under the range and above the range. All right, so what I'm looking to do is basically, if the market fails one side of the range, let's say it breaks below and then starts to trade back up inside it. All right, I'm looking to get long on the failure of the range break and ride it up to the other side of the range, because I expect that the market will get to the other side of the range to take out those stops. Why does the market go towards this area? Why does the market want to take out their stops? Because that's where the orders are. All right, and you have to take this with a grain of salt, because this is not an absolute, but in general, the market has filled all these orders in this area. So let's just say that the market has broken to the downside and then has now rejected sharply and started to trade back up inside the range. There's no more orders left to sell in this whole area because all those orders have already been filled. All right, so the market will go wherever the orders are. Where are the orders? They're going to be up here. All right, now it doesn't always happen that way, but generally that's the case. All right, these orders have been cleaned out. Where's the market going? It's going to the other side of the range to take out those stops. So let me pull up an actual example. And let's see what we got here. Okay. Now, looking at the chart, you can see a couple things. First of all, I think you can see the range here. All right. And if you look to the left, you'll notice that the market has made an attack to the upside and then dropped sharply away from it. Okay, so creating basically a small swing point in this area here. All right, but the market doesn't really get any traction to the downside and actually breaks that high and then breaks even further. All right, but what does the market do? The market starts to range right on that level. Okay, so again, at this point, everyone's looking for market direction. They don't know which direction the market's going to go, but stops are going to accumulate at the bottom. Buy stops are going to accumulate at the high, and whichever order gets triggered, the protective stops go on the other side. So when this market broke to the downside and rejected sharply, I'm looking for it to get to the other side of the range. And I actually have a video of this particular day. And let me play this here. Okay, so coming into the market, you can see the range clearly. You can see that on the opening candle, the market starts to push away. Looks like it's going to attack the top of the range there, but we're not sure. All right, and then does this. Okay, now this in and of itself, this looks like a pretty bearish candle. All right, and if that doesn't look bearish enough for you, when it breaks, you can bet that traders are now piling onto this move, and that's what I'm thinking. All right, so and it's not just that that sell stop orders would have been triggered in this area. It's that the fact that this kind of candle is the kind of candle that suckers people to initiate. So if they were on the sidelines and they hadn't had an order in to begin with, then they're probably going to be hitting the bid once they see this. Okay. So what happens next is that the market rejects sharply back inside the range. Okay. And once that happens, and it's arguable that I entered this just a little bit early, but I had already made the case for it. And you see, the first thing I do is I just get my stop under there, but I move my target to the other side of the range because I'm expecting it to get there, because that's where the orders will be. All right, and this market actually continued much higher. So just a basic example of a range play. What I call and it's just what I'm calling it. I'm calling a reversal at a range. All right. Now I don't know which direction the market's going to go, but once I see that, once I see the market has appeared to have found direction, traders piling on short and then rejecting sharply, then I have a case for a trade. So let me show you another example. All right, now this one isn't as obvious, but off the bat, you can see that the market's going sideways. All right, so there is a range, even though you can't really clearly identify the top and the bottom of the range, but the market is going sideways. So you can bet that traders are looking for a direction in the market. So now I marked off these levels here because this is where it stands out to me. And you can see that the market has broken to the downside, rejected sharply. All right, and where is it going? It's going to the other side of the range. All right, now interestingly enough, that's not the trade I took. I actually took a trade short when it failed this side of the range. All right, so you can see, and in particular, this candle is interesting because What's happened here is it appears that the market's found direction. In fact, it's actually broken to the downside and looks like it's found its direction to the upside. All right. And it manages to stay above for a little bit of time. Now, even though you have this wick here, which would be a sort of a warning sign, the next candle seems to suggest that the market's going to continue higher. And once the market does that, this gives me, I can infer that traders are buying at this high, having seen this whole context, having seen it fail to the downside, broken above this area semi-cleanly, and it looks like it's going to continue to the upside. All right, and then on the next candle, we see this huge bearish move. And I also just drew this in. It's you can also just draw a level here if you're looking at this as the bottom of the range. But so once this bearish candle came in and closed well below the range, what I'm thinking is that the traders that have bought up here are now trapped. Of course, I don't really know that they're trapped yet. But this candle provides those buyers an opportunity to exit because you can see this wick, the way this wick came in here. Why didn't this market continue? Well, it could be many reasons, but most likely because everyone who bought up here realizes that they're in trouble on this bearish candle and are now looking to get out. So, as a matter of fact, if you were really aggressive and saw this as confirmation that these traders are now trapped. The bulls are trapped up in here. This is their exit point, and so I waited for a rejection and just a clear sign that we weren't. The move to the upside was just not happening, and looked to take it short. And I get out at the other side of the range, which is just basically in this area here. So on to the next setup. Okay. Now I have something called it's reversal at the left eye. Now if you go back to my description, my drawing of how this works, and let me pull that up. So now this again, this is a pin bar setup, but the mechanics behind it are basically that there was some sort of level, some sort of key level that's been broken. All right, and you can see what happened here. It broke this key level on this candle. All right, and what happened was when it broke to the upside, what that means simply is that traders had bought the break of this level. All right, and it rejected sharply. So every trader that had bought up in this area is now potentially trapped. All right, again, we don't know that they're trapped or not, but it's a good bet that if I were in this move long and I saw this, I'd be looking for a way to get out. All right, and where would most traders have bought into this move? It would have been the break of this level here. So it makes sense that their exit point is going to be somewhere around that level. All right. Now this is just pretend that this is a daily chart, but let's go back to the head and shoulders pattern, and you can see again, traders look at this and say, okay, well this is a perfect head and shoulders pattern. You got, you can see the clear shoulder here, the head, and it looks like it's forming another shoulder. But see if I can get this here. This level is what I would call the left eye. All right, or the left eye entry. It's not the left. This is technically this would be the left eye. But whatever level corresponds to the left eye, this is where I'd be looking for a trade to get short in this instance. All right, because price has broken above, closed or traded back well below it, leaving those who bought the breakout of this level looking for a way to get out. All right, where are they going to get out? Scratch. It's going to be somewhere at the left eye level. So let's take a look at some examples. Now, for the criteria for this, the market has to have solidly broken through a key level. And then what it has to do is trade well back into the range, into the prior range. All right, I'm just going to show an example of that. The implication is that traders are now trapped, having either sold the break and now price has gone against them, or bought the break and the same thing. And then what it must do is trade back to the left eye and then reverse. All right, so showing an example of this. Now you can see that I bought at this price level here, sold here. All right, now what exactly what I was I looking at here? All right, well, first of all, there is a level here. Okay, and you can see there's resistance, resistance, support, support. All right, and then price breaks through. You can see this solid candle here. All right, now this may not look like much of a level, but just looking at the way that price had broken through it tells something. All right, and so once price is broken through like that, it's a pretty good bet that this is a level that people were looking to short, and they did. Price has gotten through, and you're going to get selling all throughout. You're going to get selling up above this candle, below the candle. You're going to get selling all the way down to the bottom here. All right, and then price starts to retrace, and it doesn't seem like much of a tracement. Comes back up, tags the level. All right, and then just pauses for a moment. You can see that here. And then price breaks above with this kind of a candle, okay? Now, at that point, again, we don't know that traders are trapped having shorted, but it's a pretty good bet. So the next thing I'm watching for is to see how price is going to trade back into this level here. All right. And I can't remember exactly what in particular I saw, but there was probably some sort of rejection in this area, and got long when it seemed clear that price wasn't breaking through the left eye. All right, but that's this is an example. Now, if you look at this dip, you look at this this dip and this rally back in. That doesn't look like a pin bar formation or a hammer formation. But that's basically what's happening here. And if you were probably to look on this on a higher time, look on this at a higher time frame, it might look like a hammer candle. But it's basically the same idea, where you have a level, people shorted through the break of that level, it's traded well back above it, and now it's coming back for a retest of that level. Let's look at another example here. Okay. So I had a trade here where I bought and sold it way up here. I guess I was trailing this one. Now, this looks like a mess, but there is a level here, okay? And price had broken through it, as you can see there. And interestingly enough, there also was a level down here in this area that price was trading into, which just sort of sweetens the deal, because you have traders that are initiating short right smack into a level where everyone's looking to get out from the last place that traders were trapped, which would be here. Because if traders had shorted in this area and then price went against them, they'd be looking to get out at scratch when price comes back to the level. All right, and you can see that these two candles pretty much wipe out this this down move. All right, so once this happens, I'm already keeping my eyes fixed on this level and just seeing what happens when price comes back to that level, because that's the left eye of the break. And once I saw a rejection off of that level, then it's time to go long. And just interestingly enough, there's also a level up here which price had obviously tried to break up here, and you can see that it got cleanly above that area. But let's look at another example here. Okay, now this one, uh, context. All right, so we had a bearish move down, and then the market goes sideways. All right, had another bearish move down, and the market goes sideways. Okay, now looking at this level here, the market once again breaks the downside. It doesn't really get anywhere. It actually trades back up inside the range. But in the next candle, it actually makes a new low. But it still can't close below the new low, or the previous low, I mean. All right, and then on the next let's see here. On the next candle here, looking at basically these two candles here, these two candles pretty much wipe out this whole bearish range, okay? And so once that happens, again, I'm looking at the place where everyone probably looked for a short, to short the break of. You could look at this level, you could also look at this level, but basically this whole area is, this whole area is where shorts would have gotten trapped if they had, if any shorting that had taken place in this zone. So I'm looking at this level for a retest. So anywhere in this zone, basically. But now, what better to get on a retest than when you have a nice bearish candle just hammering right into the level and then rejects sharply. That's where I went long. I took a portion off here and then took the rest off well up here. I'm basically looking to ride it back up into this this zone here. Okay. On to the next setup. All right. Now, this one is a very basic support and resistance setup. And as anyone who understands the very basics of support and resistance, we all know that support turns to resistance when broken through and vice versa. And so just to illustrate that, if you have something like where the market's doing this, all right, and the market breaks out, there's a level of resistance there. The market has broken out, and so we can expect this to become support when price comes back to it. Okay, so that's the very basic idea. But there's a lot of nuances to that, and what I'm looking for is, first of all, just levels that have made it obvious that there's a lot of sellers that have sold this market. All right, because what I'm expecting is that if price were to break through, then it's those sellers that are looking to get out at scratch at that level. All right. So that's just a very, very basic setup that I look for, but it is something that I look for. So price must break clearly past a key point of resistance or support, create some distance above or below. So in other words, it must be a convincing breakout, because what I don't want to see is that, let's take a look at this example here. Let me draw this again on a different chart. And okay, so we have a level of resistance here. All right, what I don't want to see is the market to pop through and then immediately reject down, okay? Because all that is, to me, is this is just a stop hunt or a fake out, all right? If I see price break to the upside and then immediately come crashing back down, I definitely will not be looking to buy there because the likelihood is that this is actually going to be a fake out, and then price could continue to the downside. And if you're looking at it in terms of a candlestick pattern, that might look like, well, it would look something like this. So the market would come up, and then it would look something like a pin bar. All right. Another way that this another way that this can look is it could look like a big bullish candle, which I actually like these even better for instance, if I were looking to go short. because you'd expect a lot of buying, expect a lot of buying to come in after a big bullish candle like this. All right, and let's just say like the next candle comes down short. Okay, this breakout were real, this should not happen. All right. So just something that I keep in mind. But just because I see a bullish candle like that doesn't mean that I'm immediately thinking about buying at this level. I'm waiting to see how price trades back up, back to the level. And the reason why I like it to, first of all, it needs to put in some space. Let me just go back here. The higher it breaks out, or the further it gets away from the level, tells me that the breakout is a real, I guess it's the only term I can think of, but it's a real breakout versus a fake out, because I don't want to see it where it just sort of pokes above a tiny little bit, because that's not really, that's sort of nothing. All right. The bigger the breakout, the other thing to keep in mind is that the higher time frame traders are more likely to see it as a breakout if it breaks, the farther it breaks away from the level. Because on a 1 minute chart, I mean, it could look like a pretty big breakout, but I guarantee you on an hourly time frame, or it's going to look like a little blip. All right, so the further it gets above, the more likely it is to be picked up by those traders that are trading higher time frames. They don't even look at the lower time frames, and they're thinking, oh, okay, yeah, this looks like a level that I might want to get involved in. And so I'm counting on their order flow as well to for them to line up bids at that level. And also the other thing is the amount of space that it puts out after price is broken through. I want it to, again, not come crashing back down to the level, but actually have put in a little bit of space between the time it's broken out. And again, this has to do with the higher time frames, because the longer price actually stays above, the more chance it is that the higher time frame traders are looking at this and they're seeing that price is staying above. A lot of the higher time frame traders they're not just jumping in the market right away. Let's just say that this was on a higher time frame. Let me just see if I can draw this out here. If you have a level of resistance and the market has broken out, if you're a higher time frame trader, what you're usually going to want to do is not take a trade until the candle has actually finished forming. All right, so if it closes like this, then that's when the higher time frame traders are likely to be seeing this as an actual breakout. All right, and so even better if price starts to do something like this and stays above the level, all right, then you're more likely to get bids lining up when it comes back for a retest. All right, because a lot of times, again, what will happen is that if price were to break to the upside, but then quickly reject, by the time of the close of that candle on a higher time frame, it's probably going to look something like that. And let me just draw this a little bit differently. Let's just say it looks something like this, actually. Okay. So on a higher time frame, this doesn't look like an incredible breakout. So are there going to be bids lining up here on a retest? especially if the next candle looks something like this. Maybe, but it doesn't look as great as a candle that breaks above and sort of puts in some time, puts in some space above that, so that it's everyone has seen it as having stayed above the level, and so when it comes back, there's a more likelihood for buyers lining up there. So anyway, so that's the basic idea of what I'm looking for. And let's show some examples of that. Okay. Okay, so for the first example here, you can see that I bought here and sold here. Okay. Now, the first thing you can see is that there is a level here. All right, the market was in a downtrend, pushed to the downside, paused, pushed to the downside again. And at this point, it's not really clear that there's a level, but you can see that the market actually started to range in this area here. So there was resistance, 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 and you can see that there's also the bottom of this range as well. And notice that the market actually did make an attempt to break that side of the range and traded back up inside it. And this is actually, although I wouldn't call this the best left eye entry, it actually does qualify. So given that the market has failed to the downside, and then look what happened afterward. There was a bullish run up right back to the level, pauses for a moment, and then breaks cleanly above the level. Okay. Now I say cleanly. You might look at this and say, well, that's not the cleanest break. Just the fact that it got far enough away from this level, given also the context, the fact that it couldn't get to the downside, actually broke to the downside, trapping those traders. They have to pay up to get out of their position. It's broken well out of the other side of the range here and put in some space. So it didn't come crashing right back down. It's actually stayed above and then starts to come back down. So immediately when this has happened, I'm looking at this level for a retest and just looking for some sort of price action to show that it's going to bounce off that area, and I get that here. Let's look at another example here. Now, you can immediately see this bearish move down here, which breaks through this level. All right. And then the market starts to find buying basically in this zone, which you could say, well, this buying probably is in relationship to this level. You see the buying here, the buying there, buying there. This is also making higher highs each time. But price cannot stay above this level, and it keeps on being met with selling and more selling and more selling here. Okay. Now, what's particularly interesting is this candle, which looks rather bullish. All right, and it looks like with the higher highs and this bullish move, that this is going to be a failure to the downside. All right, and then immediately on the next candle, we get this bearish move. All the bulls realize that they're wrong and get get the hell out of the way. So once that's happened, it's a good bet that the bulls have lost this battle. And so when price comes back to it, I'm looking for a retest of this last little area here, especially just because of this particular bullish candle, which with this kind of candle, it's likely to have suckered in more bulls to get involved on the upside, and then they're now trapped, so they're looking to get out. So this is a good break and retest. So it's broken to the downside. And when the market has come back for a retest, I'm just looking for signs that obviously there was enough bullish pressure to push price back up to this area, but I'm looking for signs of no follow through in this area. You can see that we got this wick, and then on the next candle, it just starts to collapse. So I get in short there and take profit right there. Now here's another one. Now this one. This, I just got done saying how I like space, and this one has almost none. But again, just the context of this. We had this really good level here, and you can see also we're in a range, and the market has busted to the downside and then traded right back up in it. You can also see that there was a retest of the underside of that range, so you could call that the left eye entry. The market has tried to get above the side of this side of the range, the top of the range, and failed, and then actually comes back. So either one of these actually could be a left eye entry, but you can see that the market finds support here, right on that level, and then starts attacking the upside in earnest. And even though this isn't the cleanest break, it's put enough. It's gotten far enough away from the level that, and just given the context that it failed this badly to the downside, that is a good bet that all these sellers are going to be looking to get out. And so immediately I'm looking for a retest, and I'm actually looking for a retest in this area here. All right, because it's this last when sellers are urgently trying to get out of their position, they're going to get out at whatever price they can, and there's going to be a competition for getting out. Who's the if the move is urgent, then they're going to get out the first available price, and so this is the first logical area where buyers will step in, and so I was looking for something to happen in this area, and you can see the move that happened after that. You can also look at this and say, okay, this is a good strong momentum move, broken cleanly through this level, and we have a pause and then a second stage. So it's just another thing to look at. Okay, now this one is a little difficult to explain, but I'm actually going to show some videos to explain exactly what it is that I'm looking for. Basically, what needs to happen for this is that it needs to look like a momentum move. In other words, it's got to be the kind of move that looks like traders are piling on, because the market has sort of sprung into action, and it looks obvious that the market's going to go in one direction. And then what needs to happen is that the market needs to literally just stop in its tracks. All right, and just show signs that there's absolutely no follow through, that there's no more interest or no more conviction of the bears or the bulls to push a price in that direction. All right, so what I have to be able to infer is that no one is stepping in to lift the market higher or hit the bid lower, because they should be if there's a perceived strong bullish move or perceived strong bearish move. So let me play an example of this one, and I'm going to skip ahead here. And you can see me. This is actually back from my demo days. This is last year, June 19th, 2013. And you can see it looks a little tough to see what's going on in the market here. There's obviously a little minor swing point here, if you consider anything on the 1 minute chart a swing point. But on the open, we start to get this bullish move. Okay, and it sort of looks like it's struggling for a little bit, and then it starts to do this. Now, given the context of what's been happening before, now this is of course before the market opened, so there's not going to be a lot of volatility, but it looks like the market has found its direction. It's just sort of sprung out of nowhere. This move just came out of nowhere, and this is a kind of move that a lot of traders who are bullish are likely to start initiating, seeing this. All right. Now, what happens next is that the market starts to just slow down. So there was this seemingly strong run up, and then the market just sort of just sort of drifts away, which shouldn't happen if there's a big bullish move. Okay, if sellers, the thing about this is that what's unique about this is that it's not like sellers are stepping in, strongly rejecting. What this is that it's buyers who have lost interest to take the market higher. All right, which is interesting in this situation. Now there is a second run up, and at this point I'm watching very carefully to see how this plays out because I want to see if this high is broken. I want to see if this level is going to be broken, and I want to see just how much conviction do the buyers have to push price higher. And again, the market takes a run up and then just doesn't really go anywhere. It just sort of dies. So when I see that, that's when I'm ready to hop on board the trade. So let me show you another example here. Let me see if I can skip ahead here. Okay. All right. Now, what it looks like has happened is that there's a pretty strong bearish move. All right. And then you see some buyers stepping in. The bears are coming in again. After a bearish move like this, we really shouldn't be seeing something like this. All right. Because what that tells me is that the bears just don't have a lot of conviction to take price to the downside. Okay. And so the price just rockets to the upside after that. Let me look at another example here. Going back to this example, actually, the key point here is that, like I said, it needs to look like a momentum move. All right. But then it just has to visibly die. So in that candle formation, why isn't this market continuing further? Now that was definitely an aggressive trade, but let me see if I can show you another example here. Okay. Now this one actually broke through a level of resistance. All right, so it's the kind of thing that would look like a breakout. But you can see how price just stopped there? And it's like there's no buyers that are stepping in after a breakout like this, which they should be. Okay, so a little bit of buyers do step in there, but it's just not going any higher. Why isn't this market just taking off? How much interest do these buyers have? I mean, where are they? You notice it doesn't seem like the sellers are rejecting strongly. It's just that the buyers have just lost interest to take this market any higher. Okay, so I'm just waiting to see what happens in the next candle here. I think I probably would have entered a little earlier now that I look at this. This is back in August of last year. You can see you actually do get a little bit of a retest here. So some buyers do step in, but those buyers don't really have a lot of conviction to go to the upside. Now, if I were trading this now, I actually would have been in this move a lot earlier. Yeah, I got in this one particularly late, but this should illustrate exactly what it is that I'm looking for here. And actually, I got a little bit smart with this one. Yeah, except I got stopped out there. But yeah, I was looking to extend my target, um, expecting after, if you see this candle, which looks particularly bullish, you can expect that the buyers are getting suckered into that move. All right, so where their stops going to be, their stops are going to be around in this area. So I'm looking for a price to sort of propel through those stops, giving me the order flow I need to actually push price a little bit further down into this area here. So another example. See the same sort of thing where price just sort of rockets out of an area and then there just isn't a lot of conviction. All right, you can see that. You can see the way the candle just sort of, it sprung out and then just died. So I'm looking for, and that one actually got stopped out of break even. But you can see the concept of where it got to. This one I think is a more recent example. It's August 21st. Okay. Yes, yeah. So this one, I think I actually did a video about this one, but you can see the bullish move. You can see this candle here with this wick, it rejected, started trading up in this area here. Looks very bullish. And then what happens? Look at this candle, and you can just see that it's just not continuing to the upside. All right, now this one I actually just waited a little bit because I wasn't sure. I wanted to see some buying stepping in, and then I see that bearish flash. What I'm actually doing here is I wanted to get in the market at a better price. I didn't want to enter down there, so I was actually waiting for a little bit of a retrace. And I also was curious to see if, maybe I was wrong and this market would actually just suddenly continue higher. Once I saw a little bit of rejection in this area, then I was looking to take a trade short. So that was that. Okay. Now this one, same thing, but this one is a little bit different. And I did a video about this one as well. But what's happening here is that there was a level. You can see that here, and actually you could draw this level all the way throughout that. It's sort of the middle of that range. But this had all the makings of an expected breakout of this area here. All right, and especially considering that it actually had broken down through this range and failed to the downside. So now price was going it was starting to drift upwards and got hung up in this area here. You can see the support here, and I'm actually expecting a breakout because I'm also thinking about the market potentially getting to the other side of the range because it's already failed to the downside. All right, and so on the market open, I'm watching this happen. Okay. Now that was the opening candle. And I'm thinking, okay, we've had a failure to the downside. Started making these series of higher lows, higher lows, higher low. All right, these aren't really higher lows, but you get the idea. And price just put in that last final push to the downside, and now it looks like it's about to take off. All right, so I'm expecting this level to break and wondering what my first setup is going to be exactly. Now, what's interesting is that sellers have stepped in and then you see the way the candle just died. I was expecting a breakout, and there's no one stepping in to buy. Okay, so we do get a little bit of buying there. You can see that. All right, and the moment I saw that, that's when I immediately smashed it short. All right, because what I saw was I was expecting a breakout. I was expecting price to get up in this area. I'm sure other people were too, having seen the way that candle was forming, and the market just died. And so once the market's tipped its hand like that, um, it's pretty clear which direction the market's going to go. That one just went straight to target. Now, the last setup in my my toolbox of reversal setups is what I call a reversal at the C point. So if you think of an ABC pattern, and just to illustrate this one, the thing is, again, yeah, like I said, everything is connected. And a lot of these setups that I trade look pretty similar, but they're just different little nuances. But basically, with this kind of a setup, I'm looking for the market to have made a pretty good push downward if I want to get long. Just flip that around for if I want to take a short. But the market makes a move, all right, and then starts to find a to retrace. All right, so it shows that there was potentially some resistance in this area here. Okay. And then what I'm looking to do is wait to see if the market's going to continue down further. All right, because this is what most people would expect. So the market has come down like that, retraced a little bit, and then it's going to continue down to the downside. What I'm looking for is to see what happens in this area here. All right, because if price were to come back down and then reject in this area, what I'm thinking is that we actually have, and I would label this A, B, and C. All right, and so that's what I call a reversal at the C point. Now, I mean, you can call this whatever you want. You can this could be a 1, 2, 3, whatever it is. That's basically what I'm looking for. And here's the criteria exactly. All right, so the market must have traded to an extended point, formed a relatively major low or high, and then it has to pull away from that lower high. So, and this is also the other key point is that it has to pull away from it decently enough to scare the traders that had potentially gotten short in this area. All right. And usually the way that happens is that the market's sort of just attacking the downside and buyers might be stepping in here, stepping in here, stepping in there, stepping in there, and the market just keeps on just relentlessly plummeting to the downside, and just at the point when everyone just throws in the towel and think, okay, that's it, this market's just going to absolutely collapse. The market then pulls away, okay, leaving those traders that had got it initiated at the very bottom, realizing that they had initiated at the very bottom, and they're looking for a chance to get out. Okay, so it's similar in concept to pretty much everything else that I do, but with that sort of nuance. So the third criteria is that it has to retrace back to that new lower high, so that it looks like it's actually going to break and just continue with the original trend, but somehow fail. All right. And so the example I want to give here is now you can see that there's a level of support here, and price broke to the downside pretty strongly. Okay. And then the market, now there's no I actually had a level marked in this area here, but the market actually cleanly got through that, which is even better. I love this because it actually causes more shorts to initiate in this area because the market just sort of seemed to ignore that level entirely. All right, so immediately after those shorts had entered on this candle, we can see the market starts to find some buyers. All right, and even though the market struggles a little bit, uh, the market starts to show signs. Looking at this bullish candle in particular, um, starts to scare the traders that entered short. All right, so you can see this big bearish move, and then what I saw in this particular setup actually was that we were forming would look like a bear flag. All right. So, and the basic idea with a bear flag is that you have a strong bearish move down. The market starts to form this flag. All right. And then the expectation is that it's going to break the bear flag and then continue to the downside to continue either the second stage of this move, the second leg of this move. But that's the basic idea. And what I was looking for was any sign of rejection in this area because I'm thinking that this might be a potential reversal point, thinking that this could be an A, B, C type of pattern, and which is exactly what I got in this particular situation. So even though I entered in early, you can see on this candle pretty much sums it up with this bullish candle here. The market had paused, formed an inside candle, looked like it was going to continue the downside, and then rejected sharply. So now in this setup here, you can see that the market was trending downwards and then starting to gain momentum to the downside. All right, and then all of a sudden, out of nowhere, this candle comes. Okay. Now, the moment this candle shows up, you got to know that anyone who had sold at this point is now going to be panicking because I know I would. If I had sold down here and I saw this candle, that is a bad sign. And to make things worse, the market is staying above. So it's starting to get traction to the upside. Now you notice that it actually does retest this level here. All right, and then start to find some selling off of that level. But again, just remembering this context, just remember this huge bullish move that just wiped out basically these two candles, these two bearish candles. I'm already looking at this whole area as a potential reversal point for traders that had shorted down here, that are trapped and looking to get out in somewhere in this area. And so we actually do get this rejection here, and I bought here and sold right there. So, okay. So I'm going to stop there for now, and I'm going to cover what I know about momentum in the next video. So stay tuned, guys, and hope this has been helpful and informative. I'm sure I've left out a million things, but hopefully if you guys have any question, have anything that just doesn't seem clear, because I don't know how clear I'm being with these videos, to just let me know, and I'm happy to clarify anything. Take care, guys, and have a good week.